January 17, 1980. Nelson Bunker Hunt stands in his Dallas office watching a screen. Silver just hit $49.45 an ounce. His brother Herbert is on the phone with their bankers in Switzerland. The numbers are staggering. They control 100 million ounces of silver, 1/3 of the world's tradable supply. On paper, they're worth $10 billion. Bunker smiles. He's beaten the system. He's cornered silver. The price climbed from $6.08 in January 1979 to nearly $50 in 12 months. That's 713%. He took delivery of the physical metal, chartered 3 Boeing 707 jets to fly 40 million ounces to Swiss vaults, armed cowboys from his Texas ranch riding shotgun. This isn't paper wealth. It's real. It's his. It's sitting in 5 different bank vaults in Zurich. Here's what Bunker doesn't know. 10 days ago, on January 7th, the New York Commodity Exchange, COMEX, changed one rule. Silver Rule 7. Position limits slashed from 5,000 contracts to 2,000. Margin requirements doubled. You need to put up nearly 100% cash for new silver purchases. And Federal Reserve Chairman Paul Volcker made a series of quiet phone calls to America's biggest banks: Chase Manhattan, Citibank, Bank of America. Stop lending for precious metals speculation. Now. The trap is already set. 69 days from now, on March 27, 1980, Silver Thursday, the Hunt brothers will lose everything. Not just the $10 billion, not just their oil fortune. Everything. They'll become the biggest individual debtors in American history, owing $1.7 billion they can't pay. Their family wealth will collapse from $5 billion in 1980 to under $1 billion by 1988. Make a prediction. Can 2 billionaires with unlimited cash, physical control of a commodity, and the will to fight the entire financial system actually corner a market? Keep that answer in your head. By the end, you might change your mind. If stories like this, where the numbers tell you everything before it happens, are your thing, hit subscribe, because we're about to show you exactly why this was doomed from the moment they started. To understand why the Hunt brothers tried to corner silver, you need to understand what it felt like to be rich in America in 1979. It felt like losing. Bunker and Herbert Hunt inherited billions from their father, H.L. Hunt, the legendary Texas oil tycoon who died in 1974. The old man had been worth $6 billion, at the time, possibly the richest person in America. He'd made his first fortune playing poker in the oil fields, then struck it big, discovering massive reserves across Texas and Louisiana. But money wasn't enough for Bunker. He wanted his own empire. And he got one. In Libya, Bunker discovered the Sarir oil field, 11 billion barrels, one of the top 20 oil discoveries in human history. The field was pumping out 300,000 barrels a day. Bunker was making money so fast he couldn't count it. Then, in 1973, Muammar Gaddafi nationalized it. Took the whole thing. Stroke of a pen. Bunker lost everything he'd built there. Billions in future revenue, decades of work, his crowning achievement. Gone. Meanwhile, inflation was eating everyone alive. 14.8% in March 1980. The dollar was collapsing. Oil embargoes, Vietnam War debt, stagflation. People watched their savings evaporate. Gold had been illegal for Americans to own until Nixon repealed the ban in 1974. Silver was the next best thing, an inflation hedge, a tangible asset, something the government couldn't print more of. Here's the trap. The Hunt brothers looked at silver and saw a small market. Tiny, really. Annual global production, 360 million ounces. Total above ground supply, about 500 million ounces. The exchanges, COMEX and Chicago Board of Trade, held only 120 million ounces between them. That's pathetically small compared to, say, oil or gold or treasury bonds. Silver was trading at under $2 an ounce in the early 70s. The Hunt brothers did the math. To control the market, they'd need maybe 100 million ounces. At $2 each, that's $200 million. Pocket change for them. Even at $6, like it was in January 79, that's 600 million. They had billions. The math seemed simple. Buy enough. Control the supply. Control the price. Push silver to $100, maybe $200. Make it money again. Show the world that paper dollars are worthless, that only precious metals have real value. And for a while, it worked. The Hunt brothers' strategy was elegant. Brutal, but elegant. Phase 1. Buy silver futures contracts. These are agreements to purchase silver at a future date at today's price. Most traders sell these contracts before expiration, pocketing the profit without ever touching the metal. It's paper trading. The Hunts did something different. They took delivery. They actually wanted the physical silver. Phase 2, create scarcity. Every ounce they took delivery of was one less ounce available to industrial users, photography companies like Kodak and Ilford, electronics manufacturers, medical suppliers who needed silver for X-ray film. Less supply, higher prices. Basic economics. Phase 3, bring in partners. By 1979, they'd recruited wealthy Saudi investors, princes and oil magnates who were also terrified of dollar inflation. Together they formed International Metal Investment Group. More buying power, more control. They were buying 55 million ounces in futures contracts, taking delivery and parking it in Swiss vaults. The goal? Push silver to $100 an ounce, maybe higher. At that price, their holdings would be worth $20 billion. They'd be richer than anyone except maybe the Saudi royal family. They'd replace the dollar with silver-backed currency. Make precious metals money again. Return America to the gold standard era, except with silver. Picture this, it's working. Silver goes from $6.08 in January 79 to $10 by summer, $16 by fall, $30 by December, $34 by New Year's. The exchanges are panicking, they don't have enough silver to meet delivery demands. Kodak's costs are skyrocketing. British film producer Ilford lays off workers. Families are melting down wedding silver, heirloom tea sets, anything sterling. Burglars are breaking into homes not for jewelry or cash, but for silver flatware. Tiffany & Company, the famous New York jeweler, takes out a full-page ad in the New York Times on March 26th. The headline, "We think it is unconscionable." The text condemns anyone hoarding several billion, yes billion, dollars worth of silver and driving the price up so high that others must pay artificially high prices for silver articles. The Hunts watch the chaos and think, we're winning, we're beating the system, we're proving paper money is garbage. They're not. January 7, 1980. 10 a.m. New York time. COMEX announces Silver Rule 7. Position limits drop from 5,000 contracts to 2,000. That's a 60% reduction. Margin requirements double. You need to put up nearly 100% cash for new silver purchases instead of 20%. No more leverage. And the killer? Liquidation-only trading. You can sell silver. You cannot buy more. Not 1 ounce. The Hunt brothers' leverage, their ability to borrow against their silver to buy more silver, evaporates overnight. Meanwhile, Paul Volcker is working the phones. Chase Manhattan, Citibank, Bank of America, Morgan Guarantee. The message is crystal clear, no more loans for precious metals speculation. Cut them off. The price starts falling. $48 in mid-January. $44. $39. $34 in February. $21 by late March. Every tick down is costing the Hunts millions. The Hunts borrowed heavily to build their position, billions in loans backed by silver collateral. As the price drops, they get margin calls, demands to deposit more cash to cover their loans. Not suggestions, demands. Millions of dollars. Every single day, they scramble. Pledge their oil company, Placid Oil, worth billions. Pledge their sugar plantations. Pledge their real estate holdings across Texas. Pledge their thoroughbred horses, some with names like extravagant and overdrawn that will later seem darkly prophetic. Pledge everything. It's not enough. March 27, 1980. Silver Thursday. Silver opens at $21.62. By midday, it's at $15.80. By afternoon, it hits $10.80. A 50% drop in one day. The single biggest commodity collapse in modern history. The Hunt brothers miss a $100 million margin call to Basha Brokerage. $100 million they simply don't have. The entire commodities market goes into freefall. The stock market drops. Banks that lent to the Hunts face catastrophic losses. Basha itself is on the verge of bankruptcy. The whole financial system is teetering. $7 billion in paper wealth? Gone. Evaporated. $1.7 billion in actual debt? Owed. Real money owed to real banks that want it back now. The Hunt brothers, two of the richest men in America, are now the biggest debtors in history. Federal Reserve Chairman Paul Volcker orchestrates an emergency rescue. He doesn't want the Hunts to succeed. But he also can't let them collapse and take down half the banking system. A consortium of banks, led by Citibank, Chase, and Continental Illinois, provides $1.1 billion in credit to prevent total collapse. The Hunts survive. Barely. but their empire is over. Bunker Hunt, when asked about the collapse, will later quip, $1 billion isn't what it used to be. It's gallows humor, the kind you make when you've lost everything. Let's look at the numbers. The real numbers. The ones that decided this outcome before Silver Thursday even happened. The Hunt brothers controlled 100 million ounces of silver. The Federal Reserve controls the entire United States banking system. $900 billion in assets under its influence. Not even close. Here's the thing. The Hunts weren't fighting a market. They were fighting an institution that literally controls money supply. Paul Volcker could, and did, call every major bank and tell them to stop lending for silver speculation. No law, no regulation, no congressional hearing, just a phone call. And the banks obeyed. Because you don't say no to the Federal Reserve. Let me put that in perspective. The Hunt brothers had $10 billion in assets at their peak. The Federal Reserve System had $900 billion in assets under its influence. That's a ratio of 90 to 1. For every dollar the Hunts controlled, the Fed controlled 90. Think about that ratio. You're fighting someone 90 times bigger than you. You're a middleweight boxer stepping into the ring with a heavyweight champion. You're not going to win. But it gets worse. The Hunts bought their silver using leverage, borrowed money, they put up some cash, borrowed the rest. When COMEX changed margin requirements on January 7th, it meant the Hunts suddenly needed to deposit nearly 100% cash for any new purchases instead of 20%. Their leverage, their superpower, vanished. Think about that ratio. Before January 7th, they could control $5 of silver for every $1 they deposited. After January 7th, they could control $1 of silver for every $1 they deposited. 1 to 1. Their buying power got cut by 80% overnight. Not by market forces, not by competition, by one rule change. One piece of paper signed by COMEX regulators. Here's where it gets devastating in a different way. The Hunts accumulated 100 million ounces of silver over 7 years. 7 years of buying, storing, flying metal across oceans. Global annual production was 360 million ounces. That means in 1 year, the world produced 3.6 times what the Hunts had spent 7 years buying. The market could replace their entire position faster than they could accumulate it. But there's a problem. A massive problem. The Hunts needed the price to keep rising to justify their loans. They borrowed against silver at $40 an ounce. When it dropped to $20, their collateral was worth half what they owed. The banks wanted their money back. Not in a year, not in a month, not next week. Now. Today. This hour. Picture this. Every $1 drop in silver price cost the Hunts $100 million. From $49 to $48, 100 million gone. From 48 to 47, another 100 million. From $40 to 30, $1 billion in losses. From 40 to 10, that's $30. $3 billion vaporized, their entire position underwater, and they couldn't sell. Here's why. They controlled 1/3 of tradable silver. If they started dumping their holdings, 100 million ounces flooding the market, the price would crater even faster. Selling meant guaranteeing their own destruction. They'd trigger a cascade. Price falls, margin calls come, they sell more to cover. Price falls further, more margin calls, more selling. Death spiral. They were trapped by their own success. Let's take a quick look at the numbers one more time. The Federal Reserve raised interest rates from 11.75% in January 1980 to 20% by June. That's the federal funds rate. The rate banks charge each other for overnight loans. 20%. Think about what that does to borrowed money. The Hunts had billions in loans. At 20% interest, every $1 billion cost them $200 million per year just in interest. That's over $16 million per month. Over $500,000 per day. Every single day they held their position was bleeding them dry. And silver prices were falling. The collateral was evaporating while the debt stayed the same. Not even close. By this point you might be thinking, maybe the Hunts just got unlucky. Maybe if Silver Rule 7 hadn't happened, they would have succeeded. Let's test that. Look at what happened after Silver Thursday. The story doesn't end with the collapse. It gets worse. In 1988, 8 years later, the Hunts were found guilty of conspiring to corner the silver market. A jury convicted them, ordered to pay $134 million to a Peruvian mining company, Minpeco, that had lost money when silver prices crashed. Both brothers declared bankruptcy. Corporate bankruptcy in '86. personal bankruptcy in 88. But here's where the math predicting reality becomes crystal clear. Silver dropped from $49.45 in January 80 to $10.80 on Silver Thursday. Then it kept falling, kept going down. By 1982, it hit $4.90, a 90% collapse from the peak. 90%. Think about that. Even after the hunts were destroyed, even after they lost everything, even after they were bankrupt and broken, silver kept falling. The market didn't need them to stabilize. It corrected itself. The price returned to fundamentals, industrial demand, mining costs, actual supply and demand. Silver is a commodity. It responds to use cases, not speculation. The gap widened over time. The hunts thought they could make silver money again. The market said, silver is a commodity used in photography and electronics and medicine, not money. By 1990, silver was trading at $5. By 2000, $4. It took 28 years for silver to reach the 1980 high again, 2011, when it finally hit $50 again during another speculative bubble. 28 years. That tells you everything. The Hunt brothers didn't just lose a bet. They bet against reality, against industrial demand, against mining supply, against the fundamental nature of commodities, against the Federal Reserve's determination to maintain financial stability. And reality crushed them. Let's say Silver Rule 7 never happened. Let's say the COMEX never changed margin requirements, Volcker never called the banks, and the Hunts kept buying silver. What happens next? Best case scenario, silver hits $100 an ounce in, say, June 1980. The Hunts are worth $20 billion on paper. They've cornered the market. They're the richest people on earth. They're heroes to gold bugs and inflation hawks everywhere. Paper money is dead. Long live silver. Here's the problem. At $100 an ounce, silver mining becomes incredibly, massively profitable. Every shuttered mine reopens. Mines that were marginal at $10 are printing money at $100. New mines start up. Small operators pour into Mexico, Peru, Bolivia, Canada. Global production doubles. 360 million ounces becomes 720 million ounces per year. The supply flood begins. Meanwhile, at $100 an ounce, industrial users switch to alternatives. Photography companies find substitutes, maybe aluminum-based film. Electronics manufacturers use copper or gold for contacts. Medical suppliers redesign X-ray equipment to use digital imaging instead of silver-coated film. Demand craters. Users who needed 3 million ounces now need 1 million. The equation flips. It wouldn't have mattered because the Hunts can't stop production. They don't control the mines. They control above-ground supply, the silver already mined. But miners respond to price signals. High prices mean more supply. Always. It's Economics 101. Let me put that in perspective. The Hunts spent 7 years accumulating 100 million ounces. That doubled production, 720 million ounces per year. The market would replace that in 5 months. Not years, not decades. 5 months. The Hunts would need to buy 144 million ounces per year just to maintain their position. Where's that money coming from? And here's where it gets truly devastating. The higher the price goes, the faster the market corrects. At $50, the correction takes maybe a year as mines slowly ramp up. At $100, 6 months. At $200, 3 months. The market moves faster than any individual can react. The Hunt brothers weren't fighting the silver market. They were fighting every mining company on earth, every industrial user, every central bank, every alternative technology, every entrepreneur, seeing $100 silver as an opportunity. They were fighting supply and demand itself. And supply and demand always wins. Always. You can't corner a market when someone else controls the printing press. And in commodities, the printing press is global mining capacity. The Hunts could buy all the silver above ground. They couldn't stop new silver from coming out of the ground. They couldn't stop substitution. They couldn't stop innovation. Not even close. This isn't just about silver. This is about what happens when you confuse market position with market power. The Hunt brothers had the biggest position in silver, 100 million ounces, 1/3 of tradable supply. They didn't have power. Power isn't about how much you own. It's about how much you control. And they controlled nothing that mattered. Not production, not regulation, not monetary policy, not alternatives, not the Federal Reserve. The real question isn't whether they could corner silver, it's whether anyone could corner a commodity in a functioning market. And the answer is no. Not for long. Because markets have two things cornerers don't: time and alternatives. Think about that. The Hunts needed the price to stay high forever. The market only needed time. Time for mines to ramp up, time for alternatives to develop, time for industrial users to adapt, time for reality to reassert itself. 6 months. A year. The market had patience. The Hunts had margin calls. The lesson: leverage amplifies gains on the way up and annihilates you on the way down. The Hunts borrowed billions to buy silver. Billions. When the price moved against them, those billions became anchors. They couldn't cut losses because cutting losses meant admitting the whole strategy failed. They couldn't hold on because holding on meant endless margin calls eating through their fortune. They were trapped by their own leverage. This is about what happens when you bet against institutions. The Federal Reserve has one job: maintain financial stability. When the Hunt brothers threatened that stability, threatened banks, exchanges, the entire commodities market, the dollar itself, the Fed didn't hesitate. One phone call to the banks, one rule change at COMEX, game over. The Fed wasn't going to let 2 Texas billionaires destroy confidence in American financial markets. The Hunts thought they were smarter than the market. They weren't. The market doesn't care about your intelligence, your wealth, or your determination. It cares about supply and demand. And when you corner supply while demand evaporates and new supply floods in, you own a lot of something nobody wants at the price you need. So here's your question. Were the Hunt brothers greedy criminals who got what they deserved? Or were they investors who got crushed by a system that changes the rules when it's losing? Smart people disagree. Some say Silver Rule 7 was market manipulation, the Fed and COMEX rigging the game to protect banks and exchanges. The Hunts were playing by the rules, then the rules changed mid-game. Others say it was necessary intervention to prevent economic collapse. The Hunts were trying to corner a market, threatening the entire financial system, and regulators had to step in. What do you think? Leave your answer in the comments. Were they victims or villains? Market manipulators or visionary investors ahead of their time? And if this changed how you think about markets, about leverage, about the difference between position and power, hit that like button and subscribe. Because the numbers always tell the story. You just have to know where to look. I'm Malcolm, and this is History Meets Economics. If you think this documentary is wrong, explain where. If you think it's right, explain why. Here's another moment history met economics.